Hi everyone, Daniela Cambone here for ITM Trading. You know, I have had the privilege and the honor of doing a career I love for close to 20 years, and I have met thousands of the most insightful and intelligent people on the planet. There is just so much wisdom, lessons, and insights I have gained in terms of building an incredible portfolio and preserving your wealth. And we want to share those insights with you today. We have put together a free report that highlights some of the best knowledge I have acquired through all these years. You can get it today for free at DaniReport.com. Again, that's Danny, D-A-N-I, report.com. Don't miss out, get it now. Hi everyone, welcome back to the Daniela Cambone Show here on ITM Trading. I know you were waiting for this interview. It was a little derailed since I caught the flu. It happens, but he is here today to talk about his latest book. Jim Rickards, the best-selling author of Currency Wars and so many other books, is back with his latest, MoneyGPT, and it's another winner, already a bestseller. Jim, congratulations on the success of the book, and I can't wait to have this discussion with you today.
Thank you, Danielle. I'm looking forward to it. It got off to a great launch. It was Forbes magazine said it was essential reading.
I saw that.
The Financial Times listed it among the best new books in economics. That was a short list, but they included MoneyGPT on the list. And then Amazon has their own rankings, and they ranked it #1 new release in finance and #1 new release in economic conditions. So it's great feedback. We're glad people are enjoying it, and I would love to talk about it.
Yeah, well, like I said, it's a phenomenal read. I remember Robert Kiyosaki was one who tipped me off, saying, you got to read the book immediately. I got my hands on it. You sent it to me, and I absolutely loved it. Before we take a deep dive into the book, though, we were talking about, how we spent our Thanksgiving, and we were both with our families, et cetera. And we were, laughing about, joking really about all the news that was coming out during the Thanksgiving, all when we're supposed to be relaxing. And if I could just get you to comment on one, because I knew you were coming on today, and I was like, oh, I'd love to know what Jim thinks about this. President-elect Trump coming out, on Saturday saying, hey, BRICS nations, if you're thinking about developing a competing currency to the US dollar, forget about it. We're going to slap 100% tariffs if you're even thinking about it. Thoughts on that? Were you surprised by that news?
A little bit, but for a reason a lot of people might not realize, which is, earlier Trump had said we're going to put 25% tariffs on Canada and Mexico, two of America's largest trading partners. I think Canada probably is the single largest trading partner. So that was a shock. And then, Justin Trudeau, the Prime Minister of Canada, got down to Mar-a-Lago, met with Trump. The President of Mexico got him on the phone. So there was an immediate response to that. That was big news. But this is, first of all, 100% tariff. So forget 25%. We're talking about 100%. I think tariffs are good policy for the United States used in conjunction with other tools. But anyone would say 100% tariff is over the top. That's practically saying you want to shut down trade. So the amount was certainly eye-catching. And then, of course, Canada and Mexico are, this is the BRICS. Now he's doing this to the BRICS. Well, okay, who are the BRICS? Well, Russia is already subject to a lot of economic sanctions because of the war in Ukraine. But even leaving that to one side, China, India, Brazil, again, these are major economies. You add up the BRICS, include Iran, and South Africa is smaller, but it's almost 50% of the global population and about 30 to 40% of global GDP. So, and major trading partners in every case. So 100% tariffs off the charts, even though I think tariffs can be very good policy. And the BRICS nations are a large percentage of global trade and global output. So what's actually going on here? You have to kind of look at it that way. The reason it was surprising to me is that he said, I'm going to put 100% tariffs on any BRICS member who is working on an alternative currency to the US dollar, trying to basically attack the US dollar. Well, that's not what they're doing. I mean, the BRICS just had a summit conference in Kazan, Russian Federation, in October. very recently, and they've said nothing about working on a new currency. Now, they are working on a new payment system, but the payment system is really it's a ledger. It's fiber optic communications. It's a digital ledger, et cetera. It's a way of keeping track. So if you and I are trading and one owes the other money because we had more exports, you have to settle that up periodically, et cetera. Well, with actually nine members of the BRICS at the moment, and 17 other countries who have applied. They'll be admitted in stages. It's a very large trading bloc. It's a lot to keep track of. So they are working on a payment system. The payment system bypasses the U.S. dollar, mainly because the U.S. has thrown so many financial sanctions around. Russia's been kicked out of SWIFT. Russian banks cannot interact with basically U.S. banks and Eurodollar banks in Europe, et cetera. So it's almost as if the U.S. has driven them to come up with this payment system. But Trump very specifically used the word currency. He didn't say trading system. So he's putting 100% tariff on people for doing something that they're not doing. So I'm not sure what the point of that is, other than to fire a warning shot, say almost as if to say, well, don't even go there. But they probably won't. They probably won't go there for 10 years. This is not the currency. It might be in the works, but it's not imminent by any means.
Unless they have information that we don't have.
Well, it's possible, but the BRICS are not a political union. They are an economic, a multilateral economic organization. It's very important. I've written a lot about the BRICS and done a lot of interviews like this talking about it. So I'm not diminishing the importance of it, but India and China have their political issues, and so do a lot of the other members. So it's not a political union. It's not the European Union. It's not even a currency union yet. What it is like you say, it's a multilateral organization that's discussing different forms of payments. But as of now, China would still use the yuan, Russia would still use the ruble, Brazil would still use the real. They're trying to minimize the use of dollars. Okay, but that's not the same as having another currency, which they don't. Although they do, actually, which is gold. And that's something that seems to have escaped Trump's notice. The way you achieve what the BRICS want to do without coming up with an alternative currency is to use gold to settle the balances as I described. And if you do this on a net basis, on a gross basis, it becomes very, very difficult. But if you just say, hey, I'll keep score, you keep score, we'll have this ledger, we'll have different currencies involved, et cetera. And then periodically, and it could be monthly, quarterly, or twice a year, whatever, we'll settle it up. And we'll settle it up in gold because that's the one thing we can all agree on, and it has a fixed value. I mean, it's a floating value, but it could be expressed in dollars, actually, or in the other currencies. So if you ask me what is the common currency of BRICS in the short run, I would say gold. And by the way, they're acting that way. We all know China and Russia are accumulating reserves, but so is Iran, even though they're not transparent about it. So is Brazil and a lot of other countries. A lot of countries on the waiting list for BRICS are also accumulating gold, including Turkey and others. So, but Trump didn't say anything about gold. Gold, it's kind of hard to call it a currency at this point. It is a monetary asset, in my view. It is a store of value, and it can perform the functions we're talking about. It's not quite a currency, but it seems to have escaped Trump's notice.
Thank you for your comments there, Jim. That said, let's talk your book now. Basically, in summary, it's about AI in the realm of the global economy, a double-edged sword that you say could trigger an economic meltdown.
Right.
I want to share with our audience why you think that is. And just to be clear, because people might think, oh, is Jim like bashing AI in this book? It's actually quite the opposite. You're not at all, but you are making it clear that AI is already here. We're already using it, whether we're aware of it or not. Whether, like you say, the fridge is telling you to change your filter or the car dashboard's telling you something, AI is here. It's a reality we have to accept. But one dimension we haven't explored enough is what are the impacts AI can have on the global economy. And frankly, when I read those implications, Jim, I was terrified.
Well, thank you, Danielle. First of all, that's correct. I'm not bashing AI. It's not a futuristic book. AI is already here. It's in all the places you mentioned, your car dashboard, and Alexa and Siri, and all over the place. So it's here. It's installed in a lot of systems. I know of hedge funds that are actually using AI to pick stocks, and it's not just doing some basic research or looking at footnotes and financial statements. It's actually selecting the stocks and executing the trades. I mean, they're humans who keep an eye on it, but the AI is doing the trading. It's also ubiquitous for registered investment advisors, making portfolio recommendations to clients. Traders are using AI, again, to come up with ideas to interact with the markets. So it's here. A lot of good will come from it. And I mentioned specifically applications in biomedicine and coming up with drugs for treatments, et cetera. I mentioned it because it's important and it's happening, but that's not mainly what the book's about. What I do, I take AI, and I know a lot about it. I built deep learning models. I built them for the CIA. I built them privately, et cetera. So I know how they work with the nodes and the edges and the layers and the machine learning. And so you take a billion inputs, put them into what are called nodes. They're mathematically processed. They produce outputs. The outputs then become the inputs to the next layer and the next layer, et cetera, until finally you narrow it down to some kind of recommendation. So I have a very good working knowledge of how it works. And then with GPT is just a branch of AI. It's the one that's getting a lot of the buzz lately because it can write and produce. College kids are using it to do term papers. So that's maybe cheating, but they are. I mean, it's just a reality. It can talk to you. They can produce images, etc. So that's the kind of interactive front end with images and voice recognition. But it's really just a branch of AI. But I look at all this, and I make the point that there's a lot of good that will come out of it. It's here whether we like it or not. But there's some hidden dangers, and one of the ones I point to in the stock market, there are a couple. One is we tend to anthropomorphize things like AI. Now that just means we give human characteristics to things that are not human. So Alexa may have a nice voice, and you say, Alexa, turn down the lights, and it does, but it's not human. It's a machine. It's all math. I mean, when you deconstruct it, it's all math. It's not your friend, but we tend to treat them as friends. We give them human attributes. That means we trust them in ways that they probably shouldn't be trusted unless you know all of the flaws in them. That's really what I'm doing, is highlighting some of the flaws. So that anthropomorphization, treating them like friends when it's really just math, is a human fallacy, but it's a mistake. The second one I point to is called the fallacy of composition. Now, what is that? That's basically what it means, is that a strategy that may be very good and very smart for a single individual can be catastrophic if done at large scale. So the simple example, you're at a football game and you don't have a very good view because the person in front of you is too tall or they're wearing a hat, and you stand up to get a better view. Well, that works. The minute you stand up, you have a great view of the field. That works for you. But what happens next? Well, the person behind you stands up, the person behind her stands up, etc. Before long, the entire stadium are on their feet. Nobody has a better view because relatively you're back where you started, and everybody's worse off because you're all standing up. So there's an example of it works for the individual but fails at large scale. Now take that over to the stock market. What happens when we have a market meltdown? And they happen. March 2020, the stock market fell 30% in 30 days. It wasn't the biggest crash in history, but it was the fastest crash of that magnitude in history. And what do people do in that situation? Well, for a few days, they watch it. Oh, I'm right. The market's wrong. It'll come back, etc. But then they kind of hit the panic button. They sell everything, get cash, move to the sidelines, wait out the crash, and then when it's over, tiptoe back into the market and start to buy some of those stocks at better levels. Well, that is a really good individual strategy. It's not a bad strategy at all. But what happens when everybody does it? The answer is you have all sellers, no buyers. Markets go straight down. They blow through the circuit breakers. They go through the floor, and regulators actually have to close markets. It's not a question of a timeout or a circuit breaker. You actually have to close the markets, and who knows if it can reopen. So what I do in chapter 1, I create a scenario. It's a nonfiction book, but scenarios are a good way to illustrate this for the reader, where you've got a couple different actors. One is a billionaire family office in New York. Another one is two hedge fund operators, but they're actually criminal masterminds trying to manipulate the market in Mallorca. There's a cyber warfare unit in China. And they're all interacting in ways. And then I have a Federal Reserve Chairman who's the last to know, but that's typical of the Fed. They're usually the last to know. But through a combination of deep fakes, videos of the Fed Chairman saying things which he never actually said, but then he's on a plane and they can't reach him to deny the remarks. So the market believes the deep fake. It starts going down. The criminals in Mallorca, then they put in all the sell orders. But the Chinese are putting in sell orders at the same time, having waited for the market crash. They're not trying to make money. They're trying to destroy the Western economy. And then markets follow this scenario I described. There's a lot else in there. And it's all, having lived through quite a few market crashes in my time, I was able to, I think, add some color to make it interesting. But here's the point. There was no mastermind. The criminals in Spain didn't know about the family office in New York. The family office in New York didn't know about the cyber warriors in China. The Fed didn't know any of these things. Neither did the stock exchange. It happened. It's really a case study in complex dynamics where properties emerge from a complex situation, but nobody's really in charge and nobody really expects it. Now, some of that is human nature. I could point to financial panics going back to the 14th century. But what's new is that when you put AI on top of it, take human nature, fear and panic, and all the things we all experience from time to time, combine it with AI in such a way that there's no one to apply the brakes, no one to take the other side of the trade, et cetera. This will happen faster and in a more dangerous way than people realize.
Okay, and to that point, Jim, like you say, it could be catastrophic. And if no one's there to, press the brakes, I mean, is anyone that you know of working on a system to counter this?
Well, I actually created a system in the book and I describe it. I do paint these fairly distressing scenarios, but I don't do that without giving some solution. So let's just give a very simple example. Let's say you're driving on ice. So, you've lived in Canada. I live in the mountains. I drive on ice and snow often enough. If you're driving on ice or icy conditions and you slam the brakes, the car doesn't stop. It keeps moving. It'll probably spin out of control.
Yep.
And it may go off the road. So how do you slow down when you're on an icy surface? Well, the answer is you pump the brakes. Just tap, tap, tap. Keep two hands on the wheel and bring the car in for a stop. So let's apply that to the stock market. Right now we have circuit breakers. Circuit breakers, first of all, the market has to be down a lot, over 10%. Then they just close the market for 15 minutes. It was designed to give people time to talk to each other. But in the world of AI, nobody's talking to each other. Everyone's relying on the robots, and that's part of the point. But could you have a system? This is something called cybernetics. Cybernetics is it's an ancient Greek word, but the original meaning is the helmsman. Who's steering the boat? In other words, who's in charge? And cybernetics, as applied to this situation, would say, okay, instead of a circuit breaker where we just close the market at a point, why don't we throttle the order flow a little bit? So market's down, 5%, which is not that extreme. I want to sell 1,000 shares, and the system says, no, we're only going to execute 500. The other 500 will stay in the queue. You haven't lost any money, but and then if it's down another 5% and I sell 1,000 shares, say, well, no, we're only going to execute 100 at this point, and do that to everybody, just as a way to tap the brakes instead of slamming the brakes. There are other suggestions, but that's one fairly straightforward way of dealing with the extreme outcomes that you can get with AI.
A chapter I thoroughly enjoyed, and I'd like for us to discuss a little bit more here, is how AI can really put the banking system at risk, where we could see more bank runs, where this can be amplified.
Right.
Share with us why you think this is the case.
Well, we just talked about capital markets and the stock market, and that's
Yeah.
fine. The banking system is completely different. I mean, obviously, they intersect because banks are financing stock purchases, but the banking system is a separate, complex system. And it's one that actually the regulators care the most about. If stock markets crash, it's not good, but regulators kind of shrug and go, well, it'll come back, or, too bad. I mean, the NASDAQ fell 80% during the dot-com crash. It came back. It took 14 years, but eventually did come back. The regulators really worry more about the banking system, because that's where money is created. You have so much talk about, the Fed's printing too much money. The Fed, they do print money, but it doesn't go anywhere. They print the money by buying bonds, and then the banks that are selling the bonds take the Fed's money and give it back to the Fed. That money doesn't go anywhere. It just inflates the balance sheet. The money that does go somewhere, the money that does drive the economy, is actually created by the banks themselves, by commercial banks. When they make a loan, they put the money in your bank account. That money came out of nowhere. The commercial bank created it, in other words. And when banks get into sequential failures, it's the savings are lost, that the panic is far worse. So there are a number of ways that AI could accelerate. Again, this is about accelerating and making worse a banking panic. And I use Silicon Valley Bank as an example. That happened in March 2023. It wasn't that long ago. The first warning there is that, we have in the U.S., but also Canada and Europe, bank deposit insurance. We have the FDIC insures bank accounts up to $250,000 each. In Europe, it's 100,000 euros, et cetera. But there's some amount. But in Silicon Valley Bank, they had deposits in the billions. Cisco had billions of dollars on deposit with Silicon Valley Bank. There were crypto exchanges. When they sell crypto, you give them dollars. Well, they take the dollars and put it in the banking system. And one crypto exchange had, again, $3 billion in Silicon Valley Bank. It turns out Silicon Valley Bank, 97% of the deposits were not FDIC insured. That's an accident waiting to happen. And when you look at what did happen on the Friday night when the FDIC closed the bank, they initially said, okay, we're closing the bank. Deposits up to $250,000 are insured. No worries, your money will be available Monday morning. But for any deposits in excess of that, we're giving you like a due bill. It was like a chip. They called it a receivership certificate. And they said, we'll get back to you on what it's worth. We don't know when. Is it 10 cents on the dollar, 90 cents on the dollar? We don't know. We have to figure out the size of the hole in the balance sheet, et cetera. Well, first of all, that can take 6 months to a year. Then you have to sell assets to pay people back. There was enormous uncertainty. So then we had what I call the crybaby billionaire weekend, where everyone was, calling the White House saying, you don't understand. I mean, all these Silicon Valley startups, they've all got their working capital in Silicon Valley Bank, whether it's 5 million or 10 million. You shut it down. They can't make payroll. They can't pay the rent. They can't continue the development. Never mind the fact that 95% of those companies fail anyway. But they were just, so finally on Sunday night at 6 p.m., the FDIC came out with another statement. They said, oh, just kidding. All deposits are insured. And the next day at a press conference, Janet Yellen basically extended that to the entire banking system. And the Fed, the Federal Reserve, on top of that said, if you're a bank, a member bank, and you have Treasury securities, send them to us. We'll give you 100 cents on the dollar as a 1-year low interest rate loan, even if they're only worth 70 or 80 cents on the dollar, which most of them were because they had been bought at when rates were 2%. At the time of Silicon Valley, rates were up to 5%. Most of those bonds were underwater. So, okay, we had some more bank failures with Credit Suisse and First Republic, and there were two others, 5 banks altogether. But the point is, we got through it. But then when it was over, I thought to myself, well, what did you, the government, what did you just do? You guaranteed every deposit in the system. You tore up your FDIC ceilings. You said no limit. You guaranteed every bond in the system. You said, who cares if it's 70 cents on the dollar? I'll give you 100 cents on the dollar. What have you got left? You've just guaranteed all the bonds and all the deposits. When you have your next banking failure, what's your next move? Well, there is only one move beyond that, which is to nationalize the banks. So that's how delicate this whole thing is. Now, what does AI do to that, what I just described? Well, first of all, we all remember grainy black and white photos from the 1930s of men. It was mostly men, lined up around, with overcoats and fedoras in the rain, trying to get their money out of a failing bank where the doors were closed. It was too late. The insiders had already taken the money. Well, today it's no different. It's just called a run on the bank, except we take our iPhone, we tap a few things, we can send $1 billion just like that, and then we text our friend, hey, get your money out before it's too late. It happens almost instantaneously, number one. And number two, these AI algorithms tend to exacerbate the situation. They can be used to identify where the next banking run is going to be. So the main impact of AI in a situation like this, it takes all the danger I've described, which has been around for the history of the banking system, which going back to the 16th century, if you will, but it accelerates it, it amplifies it, it happens much more quickly than people realize, and the results next time will be catastrophic. So we're building AI into all these systems. It does have efficiencies. It does, make things easier. They always sell it on the basis of convenience. But once it gets embedded in the decision-making process, which it is, there's no human element. There's no empathy. There's no sympathy. There's no common sense. There's no something intangible, gut instinct, call it what you want, that would cause people to maybe behave somewhat rationally or understand the problem. AI just goes for the throat, basically shuts down the banking system. So these are some of the dangers that regulators have not considered.
As you say, regulators are utterly unprepared for this dynamic. And, I had Porter Stansberry on not too long ago, Jim, who I know you know well. And he was basically saying, yeah, AI is going to replace a lot of things, but it can't replace art. And in a sense, this is art. Those decision-making skills in moments like those, like a bank crisis, that's an art, right? Just like journalism is an art, or creating paintings is an art and whatnot. So your book is based on the current system of AI. Do you see AI evolving at one point that it could be so sophisticated that it could take over the art?
Right. And it's a great question, Danielle. And I've had that conversation because I'll speak with, I've spoken with a lot of technical experts and people in Silicon Valley and elsewhere. And a lot of them just kind of say, what, in the form of your question, says, yeah, Jim, new systems are always buggy. They always have things that go wrong. You pointed them out, but we'll fix it. We'll make it better. Just give it time. It'll get better. I don't think that's the case. I would say a couple of things. Number one, with regard to Porter's comment, AI can do art. It can do paintings. It can do music. You may not like it. It may not be your taste, but it can do that. But what it can't do is a form of logic that very few people are aware of. We all know inductive logic. So inductive logic is you see a whole bunch of examples of something. It's everywhere, and you make an inference. You say, well, that must be the way things are. That must be the norm because I see it everywhere. That's sort of David Hume. Deductive logic goes back to Aristotle, where you have his syllogisms. You have a major premise, a minor premise, and a conclusion, and it all flows very logically, and you can demonstrate that. Inductive logic and deductive logic are both easy to code. You can put them into computers. They have flaws. They have limitations, which is why we never got to artificial intelligence earlier. I had my first, conversations about artificial intelligence in 1979 with a consultant from A.D. Little. So it's been around since the 1950s. Why has it never quite got to the level that we see today? And the answer is it's using the inductive and deductive logic with a lot of flaws, including missed examples and false premises. But there's a third branch of logic. It's called abductive logic. It was articulated by Charles Sanders Peirce, who is perhaps the greatest American philosopher. William James credits him with being the founder of pragmatism, even though most people credit James. James said, no, it was Peirce who actually did it. He's the father of semiotics. The problem with Peirce, he was 100 years ahead of his time. So we're just now kind of catching up to what he was talking about in the 1890s. But he talked about abductive logic, and there's a lot to it, but the simplest way to describe it is it's all the things that we can't code, we can't program. It's gut instinct, it's emotion, it's empathy, it's sympathy, it's common sense, it's ways that we interact as humans, and it's not programmable. It's never been programmed, and I think the better view is that it's non-programmable. What that means is that the good news is that AI is not going to take over the world, because there's an important part of human behavior that cannot be computerized, it cannot be programmed. The danger is that we, first of all, don't realize what I just said. And number two, we let the computers take over the world, even though they couldn't do it on their own, because we're not really sensitive to those kinds of human traits that are actually how we prevent nuclear war, among other things.
Oh, yeah, nuclear war is a whole other topic you go into in the book, Jim. And just to conclude, I like the book because you talk about solutions, right? Because you're basically, look, AI is not going anywhere. The solution is not to abandon AI completely. That's impossible. So I guess just final, you got to read the book, but final remarks for the folks at home, Jim, as what are some things we should be doing, or how can we be preparing for this future? How can we protect ourselves?
Right. Well, I just pointed out how AI can cause a complete meltdown and closure of the stock markets, and how it can cause a complete collapse of the banking system. So one of the solutions is to have assets that are not digital, that are not in the stock market or in the banking system per se. I mean, I have bank accounts, I invest in stocks. I mean, I'm not saying I'm immune from any of this. I'm not. But there are categories of assets that are not digital, that are not in the markets, that are not prone to AI meltdowns. Gold, silver, fine art, land, natural resources, and also things where you don't depend on liquidity. So private equity, venture capital, it's not that they're immune from loss. Of course they're not. But when you go into a private equity fund, you don't expect to see your money for 5 or 6 or maybe 7 years. So if there's a stock market meltdown, you're like, okay, too bad. Maybe you lost some money in the stock market, but it's not really going to affect those investments, which are much more long term. So, I'm talking about diversification, but when you say that, people yawn. They go, "Oh, of course, Jim, we need to be diversified." But most people don't understand diversification. They think it's having 50 stocks in 10 different sectors. And I say, no, that's not diversified. You may have 50 stocks, but you have one asset class, which are stocks. And when you don't care, they're loosely correlated. When you do care, they're completely correlated. They'll all go down together. But if you have these other assets, and even cash, to the extent it's FDIC insured, or you spread it among other banks, gold, silver, fine art, land, or things where you don't depend on liquidity, you can build a portfolio around that, and you're going to be far less vulnerable to the kinds of AI meltdowns that we're talking about.
Jim Rickards, thank you for your time today. Thank you for taking this deep dive with us. I'd love to bring you back for our Outlook 2025. So I'm not going to wish you happy holidays yet, and Merry Christmas. We'll hold on for that. But I do urge everyone to run out and get this. It's perfect for the Christmas season, for the gift-giving season, as a stocking stuffer. MoneyGPT, Jim Rickards' latest book. Jim, best of luck. I wish you great success with it.
Thank you.
And thank you all for watching. We'll have more great content coming your way, so be sure to stay tuned to the Daniela Cambone Show. Sign up at danielacambone.com to stay on top of it all, and subscribe to our YouTube channel. We'll see you soon. Thanks for watching.